Welcome to the Riskwiser Zone. I'm your host, Lewis. Today, we're diving into the fascinating world of tech stocks and the recent AI-driven market volatility. The big question on everyone's mind is whether we're witnessing an AI bubble or a justified investment in the future of technology. Let's take a closer look at what happened last Friday. Big tech stocks took a hit, with companies like Microsoft, Amazon, Alphabet, Nvidia, Meta, and Oracle experiencing significant losses, totaling over $1 trillion. The spark that ignited this sell-off was Amazon's fourth-quarter earnings report, which revealed a projected capital expenditure of $200 billion in 2026, $50 billion higher than expected. Now, some analysts argue that investor concerns over AI are to blame for this market reaction. With tech giants like Amazon and Google ramping up their AI infrastructure spending, there are questions about the potential return on investment and the risk of overexpansion. GAM Investments investment director Paul Markham noted that these concerns will persist, citing uncertainty around the extent of capital expenditures and the eventual return on investment. However, not everyone is convinced that we're in an AI bubble. Just a few weeks ago, Meta's announcement of a 73% increase in capital spending for AI development was met with a 10% surge in its stock price, and on Friday, Nvidia CEO Jensen Huang insisted that massive increases in capital expenditures are justified, given the potential of AI technology. In fact, Nvidia's shares rose 8% after his comments. As we navigate this complex and rapidly evolving landscape, it's essential to consider multiple perspectives and avoid making hasty judgments. Are we witnessing a temporary market correction or a more profound shift in investor sentiment? The answer remains unclear, but one thing is certain: the world of tech stocks will continue to be shaped by the exciting and unpredictable developments in AI. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of cryptocurrency, where prices have been experiencing significant fluctuations. Bitcoin, in particular, has seen a dramatic drop, falling as low as $60,000 before rebounding to over $70,000. This volatility has left investors and experts alike wondering what's next for the crypto market. Some analysts predict that Bitcoin could drop even further, potentially hitting $40,000 or $45,000 if current trends continue. Others point to the strong buying resistance at $65,000 and $60,000 as a potential indicator that the price may bounce back. However, with big holders still actively selling, it's unclear whether the market will continue to fluctuate or start to plunge once again. The current price range also poses challenges for Bitcoin miners, who face an average cost of $87,000 to mine a single Bitcoin. This has traditionally been one of the signs of a bear market. Meanwhile, other cryptocurrencies like Ethereum, Dogecoin, and Solana have also taken a hit, with some falling to lows not seen in years. As we navigate this complex and rapidly changing landscape, it's essential to consider multiple perspectives and stay informed about the latest developments. We'll continue to monitor the situation and provide updates as more information becomes available. In the midst of this uncertainty, one thing is clear: the crypto market remains a high-risk, high-reward environment that demands careful consideration and caution. Whether you're a seasoned investor or just starting to explore the world of cryptocurrency, it's crucial to stay informed and adapt to changing circumstances. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at the current state of savings accounts and CDs. We've seen a series of cuts to the federal funds rate in 2024 and 2025, which has led to a decline in deposit interest rates. However, it's still possible to find high-yield savings accounts paying above 4% APY. According to recent data, the national average rate for savings accounts is around 0.39%, but top high-yield savings accounts are offering more than 10 times that rate. As of February 6, 2026, The highest savings account rate available is 4% APY, offered by banks such as SoFi, Barclays, and Valley Direct. Online banks are often a great place to find competitive savings account rates, with many offering zero monthly fees or minimum opening deposit requirements. Credit unions are also worth considering, as they can provide similar rates and fewer fees. When it comes to CDs, a 6-month CD can be a good option for those who want to lock in a guaranteed rate without tying up their money for an extended period. Currently, the best 6-month CD rates are around 4.05% APY. It's essential to remember that savings account rates can change frequently, and banks may raise or lower their rates in response to market conditions. As an investor, it's crucial to stay informed and shop around to find the best rates available. In conclusion, while interest rates may be lower than they were in recent years, there are still opportunities to earn a decent return on your savings. Whether you're saving for a short-term goal or building an emergency fund, high-yield savings accounts and CDs can be a great option. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.